Hey folks, welcome to Quantsapp and welcome back to yet another video. Are you getting started in FNO trading and do you want to learn what are futures right from the scratch in one of the simplest ways? Then this video is for you. In this video, let's understand what are futures, how they are priced, why should you go ahead and trade futures, what are benefits of trading futures in one of the most simplest of ways. So let's start this video by understanding what are futures and what the definition tells us. Futures are nothing but a derivative contract which derive their value from the underlying shares, which obligates buyers to buy, sellers to sell the underlying shares at a predetermined price on a predetermined future date. So what are futures? So futures are contract, okay? Futures are nothing but derivative contract which are deriving their value from the underlying. So now let's say we have Reliance's shares, okay? Reliance's shares. Reliance's shares price, or you can call it Reliance as the underlying, because that is where the stock price is. Reliance's stock is something what you can call it. And then you have Reliance's futures. Okay, you have Reliance's futures. What are futures? Futures, from where they are deriving the value? They are deriving the value from the underlying, which is the Reliance's shares. So that's make Reliance's futures, first of all, a contract. One thing you should understand, that futures are a contract. They are not the underlying itself. They are a contract. What type of contract it is? It is a derivative contract. Now it obligates buyers to buy, right? It obligates buyers to buy. That means if you are buying Reliance's futures contract, you are obligated to buy Reliance's shares. If you have sold Reliance's future contract, you're obligated to sell Reliance's shares. Okay, so let's understand this thing in one of the simplest ways using our tool, Architect. So you can go to custom strategy, select, your desired FNO script. Let's say Reliance, select futures. Okay, so now you can go ahead and buy this contract or sell this contract. Now let's say you want to buy Reliance's futures contract at 2,700. That means you are obliged to buy Reliance's shares at 2,700. If you have sold this futures contract, right? If you would have sold Reliance's futures contract, you would have been obliged to sell Reliance's shares at 2,700. Now the question remains when. Okay. So now the question remains when. So you will go ahead and buy or sell the shares. Okay, you will buy or sell the shares only on the predetermined future date, which is 29th of December. Okay, so two things to know. First thing is predetermined price, which is at whatever price you go ahead and buy or sell the future contract, at that price itself you are going to buy or sell the shares depending on the contract. Let's say you have bought this contract, you will buy the shares at 2,700. If you have sold the contract, you will sell the shares at 2,700. Then comes predetermined price, which will answer the question of when. Okay, when will you go ahead and actually buy the shares or sell the shares of Reliance? So that is on 29th of December 2022. So that is when you will go ahead and buy or sell the underlying shares of Reliance, okay, at the price of 2,700. So price answers the question of what price you will go ahead and honor the contract. Date address the questions of when you are going to exercise your contract. Now futures can be squared off. So there is a difference between square off and exercising your contract. You actually go ahead and buy the underlying, that is exercisation. You have bought a future contract, you sold as it is to someone else, that is square off. Okay, you can square off your trade anywhere before the expiry, but post the expiry, this futures, they won't be valid. This contract, it won't be valid because it is a contract at the end. So it will have an expiry date. Expiry date is the date on which you will go ahead and buy or sell the shares depending on your contract. Last thing is lot size, which will answer the question of how many shares are you going to buy or sell. So it will depend for stock to stock. In the case of Reliance, it is the lot size is 250. So now let's summarize it. I am creating a Reliance's futures contract to buy it at 2700 on 29th of December 2022. How many quantities? 250 quantities. If I would have sold this, I am obligated to sell the Reliance shares at 2700 rupees at on 29th of December, 250 quantities. You hit the add button and you will get to see the payoff. You will get to see on what various levels of Reliance how much PNL you might end up making. Now, there can be multiple scenarios. The price might go down. If you have bought the contract, you will make a loss. If you have, sold the contract and if the price goes down, you will make a profit. If you have bought the contract, price goes up, you will make a profit. If you have bought, if you have sold the contract and if the price goes up of the underlying, you will book a loss. So that is, from the definition of futures, and that is how exactly the futures will look like. Now the question remains, is the spot and the futures price the same? No. Futures price and spot price may not be same, okay, because the formula to calculate futures prices, it is very simple. It is the spot price, okay, plus the interest rate, okay, the interest rate which will, a buyer will require to buy the shares in order to sell it in the future. You need to add that to the spot price and minus any inflows that are happening in the stock, okay, any dividends, any cash inflows that happen, that is basically going to get divided, okay, or subtracted, okay. Dividends bracket cash inflows, majorly it would be in forms of dividends, but this is how the formula for futures will look like. So if you ever wonder how to calculate the the pricing formula for futures, then you should simply refer for this, okay. Spot plus interest rate minus the dividends and you will get the futures price. Now, because of this formula of futures contract, which makes the futures sometimes to trade below the spot price and futures sometimes to trade above the spot price. Okay, so whenever futures are trading above the spot price, it is called as contango. So if you ever hear the term contango, it simply means one thing, that futures price is above the spot price. Okay, so futures is trading on a premium. Then comes backwardation. What is backwardation? Backwardation means that futures, they are trading below the spot price. Now, why will futures trade below the spot price? Now, let's say in this case, a stock is announcing a dividend. Okay, a stock is announcing the dividend. Now, someone who is possessing the shares right now, who is going to sell the shares in the future, logically, he is getting the free profit from there. That is the sure shot profit current shareholder is getting. That is the reason it would be deducted, and the spot might trade below, the futures might trade below the spot price. So these are two terms which you should understand when you are trading futures. Contango is whenever the futures trade above the spot price. Whenever futures trade below the spot price, it is called as backwardation. If you want to know which are the uh, you know if you just look at the basis tool, it is nothing but the difference between the futures and the spot price. Okay, the difference between futures and spot is shown to us in basis. So wherever you see green, it is showing you that okay, the futures were trading above the spot. Wherever it is red, if you see red line is mentioned over here, that tells you that there was backwardation happening. The futures were trading below the spot price. So you can navigate to basis tool. So the green is telling you that it was above the futures were above the spot, and the red is telling you that futures were below the spot. Now over here you can see that this is telling you the percentage. In terms of percentage, how much percentage futures was above the spot, okay, or wherever it is red, it is telling you how much percentage. In terms of percentage, how much percentage the futures was below the spot. If you want to check the absolute difference, you can click on the basis. So you will see over here, you can search for your desired stock from the search symbol over here. So now coming to the most important aspect, why you should go ahead and trade futures. So now let's say if you want to buy Reliance's 250 shares, okay, so let's say in the spot market you want to buy Reliance's 250 shares. how much money you might end up require, how much money you would require? You would require roughly around 6,75,000. If you want to buy 250 shares of Reliance, that is, the roughly this much amount you might require to buy 250 shares of Reliance. But when we talk about futures are contract, as we understood. So you necessarily should not have the entire capital to go ahead and enter into a contract, because you are any which ways entering a contract. So you just need to pay a margin in order. So this margin is collected by the exchange in order to keep everything, the process in sync, okay, so that everybody is honoring to the contract conditions till the very end. So margin is collected by the exchange. You can call it deposit in simple terms, which will differ from stock to stock. So it will collect M2M margin and maintenance margin. But let's say the margin required for this trade is 2 lakh. Okay. So now it is very less, right? So in 6.75 lakh rupees, okay, in 6.75 lakh rupees, you would have bought 250 shares. But using futures contract, you can enter into same contract by just paying 2 lakh rupees. Okay. So that gives you one reason to trade futures contract, because it will give you the margin benefit, number one. Second thing is, when we talk about futures, okay, now let's say this goes, okay, now let's say you have two trades, you spot as well, I'm writing spot as well, 6.75 lakhs. Okay, now let's assume that if Reliance goes up by 100 points, okay, if Reliance goes up by 100 points, so let's say, okay, now the thing is, you have 2 lakh rupees, and the margin required over here, the money required over here in this case is 6.75 lakh rupees. Now you can at least buy three futures with money of this, right? In 6.75 lakhs, you can at least buy three futures, and you can keep the rest money to maintain your mark to margin. So let's say you bought three futures contract. And now in this case, how much profit you would end up making? So you would end up making, 250 into 100, right? So if you have bought only 250 shares, you will make a profit of how much? 25,000 rupees roughly. But when we talk about futures, you have three futures contract, and if Reliance goes up, okay, by 100 points or 100 rupees, this is the profit you would make, 75,000. Why? Because it is called as leveraging. You can, use leverage, the margin benefit as leveraging to, to kind of leverage your positions and to get more benefit from the market. That is the second point. Another thing is, now let's say you are holding, okay, let's take a very simple example, that you are holding, let's say Reliance's shares. Okay, let's say for an instance, you are holding Reliance's shares, and you expect that, okay, in the market there might be some correction which might happen. Okay, some correction which might happen, due to which Reliance's price might go down marginally, but again in the long run it will keep on going up higher. Okay, so let's say you don't want to move your investment at all, you don't want to go ahead and exit your positions, then you can go ahead and create a sell futures trade, and you can profit from there, and you can hedge your portfolio using the futures. So you can use futures for hedging as well. So yes, folks, that was it from my side for this video. And what we understood is very, very simple, wherein we understood what are futures. Okay, then we understood how they are priced. We understood contango and backwardation. Then why you should go ahead and exactly trade futures. The first benefit is leveraging. Second thing is, you can hedge futures. Okay, you can hedge your investments using futures. And also using futures, you can trade both the views in the market, whether it is bullish or bearish view, and it also gives you the benefit of margin. Thank you.